Hey everyone, welcome back to In Layman's Terms, your go-to channel for deciphering the world of personal finance without the jargon. Today we're diving again into the world of investing, but before we do so, always remember one thing guys, life is complicated enough, but your personal finances don't have to be. Having said that, let's get started. So high-yield savings account is like your financial safety box. It's a virtual piggy bank that earns you more interest than a regular savings account. So you can use it for parking in your emergency fund or for any short-term goals like a dream vacation, etc. So even though the returns in this kind of an account is relatively low, it's still good enough because it's one of the most safest way to invest your money. And typically these kinds of accounts have recently increased their interest rates, ranging from around 4 to 5%, which is pretty good in my opinion. Alright, so following up on the high yield savings account, we're going to talk about certificate of deposits, which is like a time-locked savings account. So what that means is when you invest your money in a certificate of deposit or CD, you agree to leave it untouched for a fixed amount of time, typically like around 6 months to 1 year or even more than that. And in return, you receive a guaranteed return of your investment in terms of interest, similar to that of a savings account. And that's excellent in preserving your capital. So this is again a very safe way to invest your money. The returns are typically not as high, but it's still higher than that of a high yield savings account because you're also parking your money. But the downside is that you won't be able to access your money for that period of time that you parked it. So if you have any long-term goals, then CDs is a very good option. Let's talk about stocks. Individual stocks are like owning a piece of a single company. It's exciting because when the company does well, the value of your stock goes up and you make a lot of money. But then when the company does bad, well, you lose all your money. It's like riding the success of a company. So this is typically a kind of investment in which you do have the potential to make huge returns, unlike the savings account. But then it's again a lot of risk involved in this kind of investment as well. So I would suggest you need to research companies thoroughly and diversify to minimize the risk in this kind of investment. And I think this is a good choice for those of you who like a hands-on approach to investing and have the time to stay informed. Mutual funds are like investment baskets. You, along with other investors, pool your money into a fund managed by professionals. These professionals or fund managers diversify your money across a number of stocks and bonds, and they try to minimize the risk and maximize the returns. And in this kind of an investment, unlike what I mentioned with the individual stocks, you don't have to be actively involved because the fund manager is doing the work for you and he's actively managing your fund. But in return, these kind of mutual funds will typically have an expense ratio, which is basically a fee that you need to pay to these fund managers to actively manage these kind of funds. So let me tell you, over time, this expense ratio could really add up. So it's better to do your research on how much money you'll be paying over time. But also these kind of funds, since they're actively managed by a fund manager who has a lot of experience, they also typically give you good returns. So depending on what kind of fund you're investing in, you could really end up making a lot of money even with the expense ratio. Index funds. So these are the kind of funds that are basically, as I would like to say, a simplified version of a mutual fund. So they aim to match the performance of a broad index, such as the S&P 500. And since they're not actively managed by a fund manager, these kind of funds typically have a very low expense ratio and they can provide you a steady growth over time. So don't expect like really huge returns with these kind of funds, but they still give you very good returns compared to a savings account or most of the times even a mutual fund. So this is the kind of an investment strategy that is for those of you guys who like the set it and forget it approach, in which you just invest and then let your money grow over time. And let me give you an example. S&P 500 historically has returned about 8% annually, which is very good, and this is the benchmark for US stock market. And let me tell you guys, trust me, a lot of mutual funds usually struggle to beat this benchmark over a long period of time. So index funds are definitely a very good investment. about real estate. So these are investments that you do on physical properties. And with this kind of an investment, you don't only have the benefit of property value appreciation over time, but also the potential to earn rental income. So this could be definitely a very good choice of investment. But apart from this, you have something else called as a real estate investment trusts, or REITs. So what are these? These are basically stocks for real estate, and they also offer the same kind of investment in real estate, but without you actually owning any physical property. And both of these options have the potential to earn you a lot of income over time. And this is a very good choice to also diversify your overall portfolio, which consists of a lot of these different options that I've been talking about in this video. Right, last but not the least, let's talk about government bonds. This is a way for you to basically lend money to the government, and in return, you get a good interest rate back from the government on your money. And this is one of the safest kind of investments because the government rarely default on their debt. One specific example that I want to give you and talk about in this video about government bonds is the Series I savings bond, which is like a savings account with a built-in inflation hedge. So these kind of accounts offer a competitive interest rate that adjusts with inflation, making it a very smart choice for those looking to preserve their purchasing power. And who's not looking to do that? Alright, that's the end of the video. If you made it this far, thank you so much, guys. Please don't forget to like and subscribe. And if you have any questions, don't forget and feel free to comment down on my video. Before I end my video, as always, remember guys, personal finance doesn't have to be complicated. It can be as clear as a day, just like our channel's mission. Having said that, I will see you guys in the next video. Bye.